There's so many stories today. So with me, I'm Ralph DeCesar. I'm with the Analysis Society. This is the second time we've had a conversation with Bloomberg Intelligence. Everything going on, the sell side, new regulations, rules in Europe, rules in the U.S. To see a company like Bloomberg build up a team like you have, putting out a product like you have, and it's very encouraging, and I think it's something that from analysts at the Aussie would be very interested in. So this is a great way to, if you haven't seen it, a great way to introduce you to it, and if you have seen it, maybe you can learn something more. So I'll hand it over to thank you.
All right, thank you so much, Ralph, and thank you everybody for coming out tonight. Like Ralph was saying, very difficult time obviously for many of you, so we appreciate you coming out, spending your evening with us. Hopefully we'll give you some good ideas of what's going on, and as well as some views and thoughts heading into 2017. Let me just take you quickly through my nonsense. PI credit, if you guys have seen us on the terminal, or if you know a lot of us individually, our job here is to put out the best credit research that we can for our clients on a daily basis. That is growing further and further, and I'll get you that in a second. Our presentation tonight, I'm going to give you an update. It's about a year ago today that you guys were here for the last time. So I'll give you a quick and dirty what's happened, what's changed. And then we're going to have three of our different teams, our big guys, our energy guys, and our TNT guys come up, give you their views as to what's going on, the key themes and ideas in their sectors. And then, of course, it's time for Q&A and hopefully one last cocktail as you find your way out. Okay, so what's changed? Our toolkit we've added to our credit medians. I know that was one of the comments that we had last year that we talked about. We added an activist model this year, which has done very, very well. In terms of the research, our coverage now is over 200 issuer names. And if there's one thing that I can encourage you to do is to hold on to this booklet that should be on the screen. At the back of it is all the company coverage that we have. Right before that is your email, phone, ID, so please connect with your analysts. They're here to help you as clients of Bloomberg. And then finally, I wanted to talk quickly about the talent that we have. Last year, I think we were a little less than half the size that we are today, so we've been growing exponentially. We have virtually every vertical in North America covered, and so I'm very excited about that. And today it looks like we did our first move into Europe with a TNT analyst, so that's going to be great. It's going to give us a nice foothold as we continue to build that into 2017. Okay, so just going through the toolkit quickly. Our credit medians, it's been downloaded thousands of times now. It's one of the more popular tools that we put together. What we've done this year to enhance it, so we've added some kind of new little charting capabilities where you can come in and take whatever subsectors that you want. So if you're interested in TNT, but specifically you want software and you want IT infrastructure, you can choose those. You can choose a rating category or multiple rating categories. You can choose whatever metric you want. So if you want to do a chart of, let's say, leverage and interest coverage, it'll populate within seconds. You can see the outliers very quickly, and hopefully that'll give you some fundamental ideas. So that's kind of like a little addition that we've added in. Noel Hebert and I also put together an activist model. Essentially, over the last couple of years, we've studied a lot of the white papers that Triangle Partners put out on some of their deals, whether it's DuPont or GE, to kind of get the lens of an activist, like what causes an activist to activate, I guess. And so we took that, and we also blended it with some of the insights that we can get from academic studies. We put that into an Excel sheet for our clients. The first version of it that came out pointed to actually Macy's and GE, I think were the two biggest ones, and go figure both of them have been hit by activists. So it gives us a little bit of confidence that the model's working. I was actually just talking to R&D today. Version 2.0 will be out, I would think, within the next couple of weeks. We added in there the ability to go back and use historic data. So if you,
Use the microphone. can hear you back here.
Okay, is this better?
Much better.
All right, I'll start all over again. All right, so in the activist model, we're adding in the ability to go back in time, to go back and check to see like, hey, in 2010, the model would have screened this and didn't happen. Some of our investment banking clients who would like to use it with their customers asked us for that, so we're putting that in. We're also adding the ability to look at European companies as opposed to just the North American version in the first version. So that should be out within a couple of weeks. Okay. In the coverage that we have of the 200 plus companies, if you've seen it, you know that right at the front of it, we have this very simple red, yellow, green tools next to spread drivers. And behind that, I strongly encourage you to click on the picture, because behind it, what you'll find is an Excel chart that looks like this. As you can see, most people don't remember all of the acronyms that you have here for all the different functionalities. I think there's over 200,000 functions on the terminal. I can barely remember 15. I think the average customer uses 3. Going at MSG and top and IP are 3. So what we've tried to do is put it in a language that everybody understands, which is in Spanish. We put macro buttons in, and we'll take you, the analysts will take you through the journey of why they think that earnings might be a negative spread driver. But I'll take you to different places on the terminal, whether it's through a dashboard, a BI dashboard, or it's through functionality. All you have to do is click the button. You think people understand button clicking? I don't think people will remember all the functionality. So we've had that over the 200 companies that we have under coverage, try to make it easier for you. And these tear sheets are savable. You can open them up anytime you want, and it'll get you to the most fresh data that is not on the terminal. Okay, we've also, as a group, because we've expanded, we're able to do much more collaborative work together, which is great. So earlier this year, as the market was melting away, we started doing screening for bonds that were yielding over 10%. And then the analysts went through their sectors to say, well, it's yielding a lot, but here's some fundamentals that might be so we have to think that it's actually not as bad as what the prices are saying. Steve Flynn will be up here later. Led the team in looking at pensions. Obviously, that's going to be a big issue for 2017. Unless the curve keeps changing over the next couple of weeks. It'll certainly have an impact on ratio. So take our clients sector by sector through. That's the story on this one. We take our clients through all of the data and all these shops. When you click on them, they're downloadable. So if you're interested in autos like I am, you can save it, manipulate it, keep it, and we'll always update whenever you reopen it again. And then finally, and I think the thing that I'm most excited about, like I said, we're over 200 companies under coverage today. We have a very full pipeline. Johnny Giordano, who I'm sure half of you know, covering the leads. He just started coverage about 3 weeks ago. So he's coming out. YCCO, from Barclays is covering the tech sector. So YC just hit the wire a couple of weeks ago. We have Paul Simonauer from JP Morgan is going to be covering consumer products and food and beverage companies. He is not on the terminal just yet. So our pipeline will be growing exponentially. We also have an emerging markets analyst. He's just getting ready to publish. Like I was saying, we just added to the team from Europe. That is our first entry in there, so that'll be another growth avenue for us. And obviously, we're doing much more in third-party marketing. I was just talking to an S&P colleague, former S&P colleague, in that we're doing webinars now. I think our first S&P webinar is actually December 8th. We've also we're working with another rating agency to do roundtable discussions with them. Through web, and obviously, market participation, and we do lots and lots of webinars. I think we have one coming up in a couple of weeks, which should be great. And obviously, we're doing more and more client meetings as the group goes out. So with that, I will take you to the stars of the evening. The finance team, the energy team, and the TMT team. I'm just going to be the page turner here, which is probably where it belongs. So let me introduce Ryan O'Connell, Arnold Kakuda, and John Giordano. I think Arnold's going to lead off with the banks. And so Arnold, why don't you kind of go on and give us your story.
Thanks, Sean. I'm Arnold Kakuda. I'm the credit analyst for banks. Right now, we have coverage for the 8 big U.S. banks, for European big banks, as well as Canadian banks. But let's go to 2017. So basically, I think the question that a lot of investors are asking themselves is, right, what do I do with banks going into 2017? Do I over or under them? And so, another way to look at that is where should banks trade versus bank financials, where should they trade versus if you look at what happened this year, the trade backs were post-crisis where so the trade that's worked post-crisis where financial spreads blew out, and then afterwards you went overweight financials, and then you made your you outperformed the index. That's worked all the way until beginning of 2016. So the spread between financials and the overall index, financials traded a lot tighter, peaking at 37 basis points tighter than the overall index in January, and then now it's pretty much flat. So basically, we had a big underperformance of financials this year, led by banks. So banks, looking at the Bloomberg Barclays index, which actually that's a huge kind of acquisition by us this year. So definitely encourage you guys to make use of it. Users can go in and slice and dice the data any way they want to. But this is a snapshot of, we looked at the year-to-date returns of the banks versus the overall index. And clearly the banks, even though it's a positive return due to the declining rates, they've underperformed the index. So by that measure, they pulled down the financial sector as well. So the bank trade didn't work this year. Why is that? Well, we had global growth concerns. We had the Brexit uncertainties and the low persistent rates. But if that seems to normalize itself out, if interest rates were to rise, the economy is healthy enough next year for a couple of interest rate increases, maybe banks will be a beneficiary of that. So something to think about. Okay, so what about, in terms of the fundamentals, post-crisis, capital levels have increased. And our outlook is for that to continue. Based on the Federal Reserve's comments in September, it looks like Dan Tarullo has a plan to have big banks increase their required capital levels. We estimate anywhere from 100 to 400 basis points of increase in their minimum required levels. But because bank capital levels are currently so high, we only see maybe JP Morgan slightly below their potential 2018 hurdles. So, but even with that, we feel like banks will continue to build a buffer above their potential capital levels. So capital levels, we think, will rise. And then technical negative for the banks is they need to raise a lot of bail-in debt. So no more bank bailouts anymore. Now bondholders will get written down in a time of crisis. So in order for that to happen, banks need to have a big enough liability stack. And so the deposit-heavy banks, i.e. Wells Fargo, JP Morgan, Bank of America, those are the ones that really need to raise the most bail-inable debt. And so we estimate that the shortfall is about $65 billion, and over $30 billion of that is Wells Fargo. And as you guys all know, Wells Fargo is going through a lot of issues with the unauthorized account scandals and their bonds toward the tightest end of peers. Right, so a lot of interesting things going on in terms of the issuance market right now. There's TLAC debt that we have a lot of these atypical bonds that are callable within a year. Since August, we estimate 20 billion of this debt has been issued. And so why is that? Well, the bonds are atypical because they're callable a year to maturity. And that coincides with the time when the debt is no longer eligible for TLAC. So that's why the banks are issuing this. And 20 billion issued. Interesting fact, over half of that has been in floating rate notes. So floating rate notes is typically demand driven. These aren't included in bond indexes. So investors should have a pretty strong view in terms of holding them. And if you look at what happened in October, right, these floating rate notes outperformed given the 10-year note increased 23 basis points during the months. So fixed rate notes had a loss for the month, right? And so these notes outperformed. So congrats to you guys who have been in the notes, the floating rate notes. And then here's a screen that I like. It compares the CDS versus the equities of the banks. And clearly you can see Deutsche Bank has been an outlier. They've had a lot of issues. The biggest, I guess, right now is the potential hefty legal bill from the U.S. Department of Justice regarding their legacy RMBS. And going into 3Q, we were hoping that they would give an update in terms of, all right, they wanted to settle a lot of their big legal bills in 2016. What we learned is 2016, the year end for them is mid-March, which is when they file their annual report. So it seems like the time horizon for all this stuff to settle got pushed back by 2.5 months. And so potentially we'll probably see more volatility as news leaks out about potential settlements over the next few weeks. Thanks. And with that, I'll turn it over to Ryan.
Great, thanks very much. So Ryan O'Connell, I joined the team here in January. Like a lot of my colleagues, I've worked at a rating agency, sell side, buy side, altogether, HR. You made it. Altogether about 20 years or so. So I cover U.S. life insurance and property casualty companies here, and also finance companies, so credit card companies. So what I thought I'd do is take one topic for each sector. And so for the insurance sector, I think what we got to think about is, do AIG and Pru try to follow MetLife's lead and get out of SIFI jail? What I mean by SIFI is they're subject to regulation by the Federal Reserve Board as a systemically important financial institution. As you know, MetLife is now out of SIFI jail. They won a lawsuit against the government. And so I think the question is, what do these other two companies try to do? Because obviously there's a lot of pressure from shareholders. So if we go to the next slide for a second. So I think in the ideal world, yes, I would like to have the Federal Reserve regulating these companies so they can control the animal spirits that you see in any financial institution. But I think as fixed income investors, what we really should think about are two things. One, are they going to lever up a lot? So, pile a lot more debt, maybe get a downgrade, maybe a lot more supply. Or two, might they do something really drastic and break up the company in ways that would be bad for us as fixed income investors? So the reason why I think this chart is interesting is AIG is in white. It's, well, this chart is sort of fouled up a little bit, but I'll tell you what it is. Anyway, this is about 26% debt to capital. And then here you've got Pru in the orange, about 23%. And then the Met, they're out of SIFI jail, they're at about 20%. So in other words, the company that has already gotten out from under the Federal Reserve has got the lowest leverage. The reason I think that's important is for about the last year, both Pru and AIG have said, it's really the rating agencies, Gerard and the others, who are controlling their capital levels rather than the Fed. And I think this chart shows you that is true. So I don't worry so much about what they do in terms of leverage. And by the way, Met probably will take its leverage. That's true, but you can see it's so much, much lower. The other issue is more complicated. But based on comments today, what I would say is that Pru has been very, very consistent. And they said, we like our business model. We like the annuity business. There's no reason to change. And I would also say, if you are punching out returns on equity of about 13%, your shareholders aren't going to put a lot of pressure on you. Now, I will agree that AIG, and today didn't help, but AIG is in a more complicated situation. But having said that, I think that Peter Hancock, the CEO, has done a pretty good job of holding off the activists and shareholders at bay. What he's done is he's selling off the mortgage company. I don't think that's the greatest move in the world, but the shareholders like it. He's given them some board seats. And in terms of what really matters, he's actually improved the operation, the core PC operation bit. So again, remains to be seen. If you go back, if you go back to the earlier slide, sorry, this is one slide again. Sorry, let's go to this. Go back to one slide. You can see the sleigh ride again that AIG's had. It's trading about 40 basis points behind that. There's a reason for that. There is still some risk, so I don't want to be too high-ish about that. So if we go forward. Now I want to pivot and talk a little bit about the finance companies. And I think the big issue that we have to think about going into next year is loan quality. It's going to stay pretty good, which has been fantastic, but it's going to get worse in a way that might affect the bond's performance. So let's take a look at what's going on with credit card companies. I think we've got a tale of two strata here. You've got Capital One here, and you've got Synchrony, very fine companies, and in each case they've got about a third of their book is in subprime credit card accounts. And you can see what's happening in terms of their delinquencies. I talk about delinquencies because they are a leading indicator of credit losses. Net charge-offs look back, delinquencies look forward. So that is something we definitely have to watch. On the other hand, if you look at people who are dealing with prime customers, JP Morgan, American Express, Discover, this is very well behaved. And so far, no indications of any breakdown at all. Now, if we turn to the car business, next slide please. Here, actually, I think things are somewhat more benign. So here's Cap One, about 35% of their book is subprime. And there's a sawtooth, I'll grant you, but they are back about where they were 2 years ago. So there's no big change. JP Morgan, a prime lender, no big change. Now I will grant you with Ally, we have seen some fluctuations, but I think it's company specific, and here's why. Ally made a strategic decision, frankly, to goose up their margins. So about 2 years ago, they started increasing the amount of subprime business they do. As you put on loans, eventually they age, and eventually losses start to tick up. Capital One does a lot more subprime, but they haven't changed the allocation. They've kept their business straight. So far, so good. But just in case, I think we have to be attuned to the fact that this could change, and here's why. On their conference calls last week, both Capital One and Ally said, you know, used car prices are down. Recoveries on repossessions are down. So far we're okay, but stay tuned. So I think so far so good, but one of the things that I've noticed is that Ally bonds have cheapened a bit, and I think frankly, you know, there's some justification for that. A reasonable investor might conclude that although things are okay right now, as we go into 2017 for the subprime business, it's probably going to get worse. And with that, I'll turn it over to John.
Thanks, Ryan. Hello, Mark. You knew you were here. So as you heard, I joined about 3.5 months ago from Credit Suisse, where I was the financial sector specialist for many years. I've done credit, I've done equity, sell side by side. And I've always covered REITs, which is one of my favorite sectors. So I'm going to keep it tight here just so we can move along. A couple things that I'm sort of watching closely as it pertains to real estate is sort of the relationship between REITs and CMBS. And to be a rebel, I use the Merrill Lynch indice as opposed to the Bloomberg indice here. We're still ramping a lot of stuff up, so historical data is coming onto the terminal. That's the real answer. And so the interesting observation here is that these two indices are literally 94% correlated over history, and they trade about 4 basis points apart, with CMBS typically trading through the REIT index. However, as you see on the end, there's about a 20 basis point difference right now. So the question is, what's going on? Is there fundamental issues with real estate, or is it another technical? Well, there's a couple of things going on. One is there may be some fundamental weakness in cap rates and credit quality, but I'm not really hearing that. We are seeing swap rates and LIBOR go up. That's really bank driven, and what's going on. Money market reforms, what's going on with risk retention and banks' ability or unwillingness to want to hold risk if they do new CMBS securities. The other and more prominent issue would be on the next slide. Slide again. And is this mountain of CMBS maturities that we have coming due in 2017. Which in this slide is about 140 billion. It's probably a little bit less than that now. Now this is well known. It's not necessarily like this. It just came out of nowhere. But it helps to illustrate something very interesting within the REIT sector. So I've covered REITs forever, and the argument has always been that REITs should trade through financials. They should trade through CMBS because it's an actively managed portfolio. There's covenants that you don't see in other corporate sectors, and they've never ever had a default. So, interestingly, what REITs have been doing this year, well, rates are low, and when rates are low, cap rates are low, which means the asset prices are high, as they've been selling. They're either spinning them off, the healthcare, pretty much every day another healthcare REIT spins off skilled nursing facility and pays down debt, whether it's secured, unsecured, and their bank loans. And I think the secured pay downs are a lot of the secured debt's here, and it's much higher coupon, so they're able to refinance it at much lower rates now in the unsecured market. And so the net effect of this would be on the next slide, is that leverage in the sector has come down a ton. And The rating agencies have recognized this because not only have you lowered overall leverage, you unencumbered a lot of assets. There's a lot more assets beneath unsecured bondholders. And so we've seen a series of ratings upgrades. So I don't know that leverage is going to get any lower because this is pretty much at the long-term historical average of around 6 times. So fundamentals are okay, leverage is great, cash flow is better, and we have more asset coverage underneath us. So it feels like the REIT sector is waiting for rates to go up next year and redeploy this capital at much more attractive rates. You really don't hear any management team saying we want to buy assets. They're just selling any of their underperforming assets. So the next thing is to say, okay, well, what's the market implying for the rates next year? So our next slide, please. This is the OIS forward curve. And not surprisingly, it shows a pretty broad flattening of the curve with front-end rates rising like you would expect during any tightening cycle. Rich, you feel free to opine. It's kind of strategist there. So my next thing was, well, okay, well, what happened last time? So 2004 to 2006 was our last time that we saw rates go up. How did REITs behave? How did they perform? What should we expect going forward? So the next slide, I had to have one with a lot of pretty colors and charts to keep up with everybody here. This is our FIW function. That's my plug. And by the way, he knows every function known to man. I promise you, I've never seen anything like it. And I thought I knew a lot. He knows them all. So what you see that you don't need to really know what all the dots mean, but this is basically all the unsecured debt that's outstanding. And it's obviously clustered between 2 and 10 years, which makes sense because that's sort of what the lease terms are, right? So their asset liability is not really mismatched, it's matched quite well. But it also shows that they're exposed to rates going up in the front end of the curve. So the other interesting point here is that, there's a bunch of dots at the end. Those dots have actually been growing. That's 30-year debt. As REITs have delevered and their ratings have gone up, they've been able to access longer term debt. So 30-year debt was usually unheard of. When I was on the buy side, PM said never buy anything past 10 years, but it's changing now. Again, history of no defaults and the ability to attain a single A rating, which they had never been able to do, has given them broader access to the market, which is great. So to end it, what happened last time, right? That's kind of my big thing here. So we took several different indices, including the REIT index we showed you in the beginning and the AA- index here for CMBS, and said, well, we know yields went up. What did spreads do? Did they compress? And so REITs actually outperformed everything but the lower rated CMBS, which they showed they came from a higher spread. The only difference this time is that CMBS is trading a little bit wider than the REIT sector, but again, I think there's a supply issue that could change that. So what I kind of say is, history doesn't repeat itself, but it rhymes. So we'll see what happens next year. Thank you.
Thanks to the guys. I think David Zell's coming up. Talk to us about utilities, followed by Spencer.
Thanks, Joe. Utilities. So, it's utilities. They're boring, regulated entities, enough to put everybody to sleep. You buy the bonds, you stick them away, not in your mattress, but you put them away somewhere, and that's generally what happens with utilities. And the last time we saw any real disruption in this market, 1995, 96, when we started the deregulation process, went, into the early 2000s, and then of course came crashing down with the Enron crisis. So since then, they decided to behave themselves. Regulators decided that they were going to take a really, really strong hand here, try to control these guys. What's happening now, though? Maybe not over the next month, maybe not the next year or 2 years, but I think you're starting to see things get into place which are really going to disrupt this industry again, right? What's the first thing? First thing is, if you look at this slide, we are just not, at least the utilities are just not selling more power. There is no growth in utility electric consumption. If you look at this chart, this is out by the EIA, it's been pretty stable over the last 2 or 3 years, and even their projections. Remember, these axes are on a different level. So if you're looking at an average about 10,000, you're looking at growth about 50, maybe 0.5% or so, okay? Now, it's important to look at the trend as well. What's causing this? So the first thing is conservation. As people are using more efficient appliances and using less electricity. Second thing is self-generation. You see solar panels everywhere. That's with new battery capacity, obviously that's just going to keep growing. And then we've seen demand response. Now, where conservation is concerned and where self-generation, renewables, etc. is concerned, Europe is actually a little bit ahead of us, and they're actually seeing negative growth. They're seeing declines in electricity consumption. So that may well happen over here. So that's the first thing. That's the first thing that's happening over here. Now, why is this a concern? It would be one thing if the utilities said, fine, it doesn't matter, we'll just continue with this flat growth, we're going to have these earnings. But the problem is, virtually every single utility management that's out there has come out and said, we are going to grow earnings by 4 to 6%, and we are going to increase your dividends by 4 to 6%. Southern just came out. They said 5%. They said not 4 to 5. They said 5% or higher is where we're going to have growth. How are you going to do that if you're simply not increasing your top line? Okay. For those of you who are familiar with the rate-based regulatory notion, the way you grow your earnings is you have to put more assets into your rate base. But if you're putting more assets into your rate base and you're not increasing volume, what happens? For everybody else, the rates go up, right? And that's basically what will happen over the next few years. Now, again, why is that a bad thing? What's happened over the last 2 or 3 years is that rates have not gone up that much, and that's really because of one simple little thing, and that is natural gas prices coming down. Now, for those of you who live in this area, PSE&G, Con Ed, when you look at your electricity bill, you're going to see two parts, right? You're going to see the energy part, and you're going to see the delivery part. The energy part, because it's based on power prices, market power prices, has been coming down, and that's because of lower natural gas prices. Which means that regulators, because they don't like to reduce your bills, right? Regulators are simply not going to reduce your bills. They're going to up the delivery part, right? Keep your bills flat, or maybe give you a 2 or 3% decline and say, you know, what a great job utilities and everybody's doing. So natural gas prices have come down. The overall bills have not gone up that much. Regulators have had a really easy time. Now, what happens? If natural gas prices stay where they are, or they actually go up, or even if they don't go up. Remember, there are two parts to this natural gas situation. One is the price of natural gas, which we measure at the Henry Hub, which is what's traded on NYMEX, right? That's around 2.5 right now. But utilities, particularly here in the Northeast, close to the Marcellus, don't pay anywhere close to 2.5. Many of them have been paying as little as $1, simply because there is not enough pipeline capacity to take that gas away. So this negative basis, if you can imagine a utility that says, look, we're basing our power price off 2.5, they actually buy it at 1.5, they generate at that level, of course they're going to make surplus profits, right? Now, what happens? If natural gas prices go up at NYMEX, if these utility pipelines get built so the takeaway capacity increases, that base is going to disappear very, very quickly. So now natural gas prices are coming up, and your regulators simply won't have that leeway to cut back, and they won't be able to give you those increases. Okay, so let's just move on to the next thing. So what does this all add up to? Okay, if you look over the last 2 years, these are metrics for all of the utilities in the Bloomberg index. The ratios are not good. You've got CapEx. This is LTM CapEx has gone up by about 25%. Dividends have gone up by about 20%. Excuse me, by about 14%. And then look at the leverage ratios: net debt to EBITDA, FFO to debt plus dividends. CapEx plus dividends. So it's been going down. Good. There are two parts, obviously, with the utility, right? You've got the regulated. The way the structure here is in the U.S. is very different from Europe. You have the operating utilities and you have the holding companies. By and large, operating utility bonds have been stable, and they will probably continue to be stable because they are protected by the regulatory compact. So unless you have a major catastrophe, in fact, I say this every time I talk to a group of people because I've been in this industry for so long. No investor has ever lost a dime on a first mortgage bond in the utility industry, even if it's been through bankruptcy, post pre-petition interest principal. So when it comes down to the operating companies, you're basically okay. The problem is going to be up at the top, at the holding companies. If utilities are simply not able to raise their rates the way they want, they may be restricted in the dividends that they pay up to the holding companies. And that's fine. That's fine so long as you're being compensated for that risk. But the problem is you're not. The difference on average between yields and spreads is only between 18 and 20 basis points. And you could be looking at an average of 2 to 3 notches on the rating scale. Interestingly, when you go out to the longer term, the spread difference is even less. So for a 25-year bond, you're only getting 8 to 10 basis points at the holding company. And the situation of the holding company is likely to get worse. I talked a little bit earlier about these bonds and the fact that these are sort of buy and hold. And when we look at the actual trading volume, this is a period of 6 months, you only got materials bonds that trade less. That'll change. Obviously, the holding company bonds will trade a lot more. You're going to see a lot more volume in these things as some of these issues develop over a period of time. Again, just to highlight some of the stability, maybe this slide could have come a little bit earlier, but these first 3 here are the utilities between electric, gas, and other. And as you can see, if you look at the standard deviation, it's much, much less than for all the others. The difference between the top and the bottom is a lot less, and the average. So for the last, this is over a period of 6 months, for the 7 to 10 years. Bonds, remarkably stable. And I think that'll change. And I think if I came here in 2 or 3 years, we'd probably see a major change in that. Okay, so I think that was all mine. Spencer, you're up. Thank you.
Thank you. So I know the theme here is supposed to have been looking into 2017. I'm covering the oil and gas sector here. I basically cover energy sector from upstream down to midstream, drilling, and services. Jamin covers the refining and marketing for me. But I really think for 2017, and maybe in the first part of 2018, it's going to possibly be the eye of the hurricane, so to speak. So what I'm really going to do here is try to bifurcate this into the very short term, meaning the rest of 2016, maybe first month or 2 of 17, and then get into a little bit of a longer term outlook. For the short term, we're in the middle of the fall borrowing base redetermination season. So for the high yield E&P market, generally speaking, every 6 months, borrowers have the size of their credit facilities redetermined by the banks based on the value of their reserves. First half of this year, for the entire first half of this year, we had something around north of 40 companies go bankrupt, impacting over $40 billion worth of debt. Well over half of that, about 75% of it came in April and May. So a lot of it was driven by this spring redetermination season. So coming into the fall redetermination season, we had over 20 companies that had utilized over 70% of their borrowing base facility, which basically means if the banks are going to give them another haircut, they don't have a whole lot of flexibility or room to maneuver. And of those 70 companies, there were even a handful that were already effectively overdrawn given their experience in the spring redetermination. So they're already trying to pay down a borrowing base deficiency from the prior redetermination. So we're probably the third inning, so to speak, of the process. This is what we've seen so far, or at least as earlier this week. A couple companies to highlight, just to kind of give you a feeling for what's going on. Vanguard Natural Resources. They were one of the companies that was working through a deficiency from their spring redetermination, so they were already overdrawn. They came out and said that they expect the borrowing base to be cut even further, so now they're going to be about $187 million overdrawn on their credit facility. They say they're going to pay that back in monthly installments of about 50 some odd million. The question is, where's that going to come from? I'm not sure. Memorial Resources Production, they're not on here, but they just came out, I think it was yesterday. They were about 78% utilized coming into the redetermination. They had their borrowing base cut. Now they're almost 100% utilized, and they decided they weren't going to make their November 1st coupon payment on their bonds. So they're talking to their lenders. PetroQuest, they had a borrowing base that was fairly small, but they're effectively 100% utilized, and they basically said, let's get rid of it. It's not doing us any good, and they found another lender to come in for a term loan. So that's kind of what you're seeing out there. You have seen quite a few kind of get a push or a pass. But to give an example of kind of the magnitude that we've seen over the last year and a half, Whiting Petroleum was at the top of the list. In September of 2015, the size of their borrowing base was $4.5 billion. Now, after their fall redetermination, it's $2.5 billion. And then you do see a few green percentages on here. There are a few companies that actually had their credit facilities, their borrowing bases increased. They're kind of rare. But the thing to note is there's two pieces to the credit facility. There's the size of the borrowing base and the size of the bank commitments. In most of these cases, while the borrowing base went up, the bank commitments didn't. So it didn't really improve their liquidity, and it kind of gives you a sign that banks are saying, yeah, value reserves may have gone up, maybe you've drilled more wells, you've made some acquisitions, but we're not really ready to increase our exposure to the sector. So based on what happens here and over the next month, I do think you're going to continue to see a few restructurings and a few fireworks between now and the end of the year, and probably some of it's going to trail into the first part of 2017. So then why do we hit the eye of the hurricane? Next slide. So this is a debt distribution profile for 15 to 20 of the largest high-yield oil and gas producers. And as you can see, there's really not a whole lot happening in 2017 or even in 2018. So there's an argument to be said that a lot of these companies, if oil does stabilize $45 a barrel or somewhere in there, you might be able to get through the 2017 redeterminations without additional cuts. Just kind of ride out the storm through that year, because there's not going to be much of a catalyst. But then you look at 2019, and that's really where the maturity wall hits, and that's in the form of credit facilities. So there's an interesting angle here that I think a lot of people, I don't know if they've all thought it through, but if you're a borrower and your bank facility is coming due in 2019, when are you going to start talking to the banks about that? Probably 2018. Usually you'd like to get that stuff done about a year ahead of time. If you're the bank, are you going to be really excited to extend maturity here out to here when you have all this debt maturing in front of you? Probably not. You could do the spring maturity, but does that really buy anything when you have maturity 6 months after you just extended? So I think you could find yourself in a position in 2018 where companies really need to start working on not just extending their credit facilities, but dealing with some of the 2019, 20, 21, 22 bond maturities in order to be able to get those credit extensions. So that kind of leaves you with the question of, what do we need? Where do we need to be in order to get there, to be able to get companies to be able to refinance? Sort of where are we today? Where do we need to get to? How long do we have to get there? So this is the how long we have to get there. We have about 2 years. Where do we need to be in terms of an oil and gas price standpoint in order for this to work? Trying to figure out sort of, $45 a barrel, which is kind of where we ended today, just doesn't work for a lot of these high-yield guys. So what does work? You see lots of earnings calls, lots of companies basically talking about if oil hits $55 to $60 a barrel on a sustained long-term basis, they could ramp up their drilling activity. The GE Baker Hughes merger, basically they said they need to see their customers need to see oil in the $55 to $60 range for a durable period. Then you look at break-even costs in various different shale basins throughout the country. It's a moving target, and every analyst has their own way of calculating, so you get stuff all over the map. If you're outside of the Permian, though, which again is the one bright spot, so to speak, in the country in terms of low costs, and you can actually still be profitable at $45 a barrel. But if you're outside of the Permian, break-even costs are generally viewed at somewhere to $35 to $45 a barrel. S&P came out with a report recently saying they think it's about $45 a barrel. But keep in mind, that's just the break-even for drilling the well and getting the oil out of the ground. It does not include overhead expense. It doesn't include basis differentials to get your oil from the wellhead to a hub. So Jaden was just talking about how you have utilities here in the Northeast buying gas for $1. You've got producers in the Bakken selling oil for $8 less than WTI. So you add on all the overhead and the basis differentials, you're easily adding another $10, $15, $20 a barrel to that theoretical break-even level. So you kind of look at, you kind of triangulate it in, distill it down, and it basically sounds like $55 to $60 a barrel is kind of what you need for these companies to just at least break even. And I don't know if banks and bondholders are willing to refinance significant maturities if you're just breaking even. I think a lot of that's going to depend on market sentiment at the time. So how long? We have to get there about 2 years. So what's the market telling us? What are people saying about the outlook for oil and gas prices? A couple of quotes are sort of looking at what people are saying. Again, the Baker Hughes GE merger, they see a slow recovery of $45 to $60 a barrel through 2019. Pioneer just this week said they could see oil in the low 40s in 2017, moving to a balanced market in the mid 50s or higher in 2018. So nobody's talking about going back to $70 or $80 a barrel anytime soon. Let's look at what the market says. This is the forward curve for oil. This was taken earlier this week, so you actually kind of have to move this down a few dollars. 2019 maturity wall, here you see $54 a barrel. It's actually today closer to 52. Again, the market's basically telling you, if this is right, we may not, be in a position where a lot of these companies, unless they can get really, really a lot more efficient in their drilling, they may have a problem. This is just oil. You may think, well, what about natural gas? It's even worse because it's sort of backwardated for the first couple of years, and so the gas prices are now expected to be below $3 back up into 2019. So that's why I think 2017, early part of 2018, maybe sort of the eye of the hurricane. We had the first wave come through in 2015, really peak in the first half of this year. We still see a few more bankruptcies and restructurings at the tail of this year, leading into the early part of 17. I think you can see companies kind of ride out that eye of the hurricane for the next 12 to 18 months, but then unless you see a meaningful rebound in oil and gas prices coming, maybe people start anticipating late 2017, but certainly 2018, you're going to start seeing that next wave of what are we going to do. That was a note.
So for more entertaining stuff, I can't believe it could be more entertaining. Let me bring up Steve Flynn to talk to some of the TNT stuff.
Great, thank you. Hi, my name is Steve Flynn. I cover cable, telecom, satellite, and media for both investment grade and high yield. So I put together my slides about 2 weeks ago for 2017 outlook. Wireless is a very important topic. There's a lot of things going on. And it's telecom. It's a boring sector. What could happen in the next 2 weeks, right? I'm fine with these slides. They're good. Little was I to know that I would see two massive deals where the buyer pays a significant premium for the target, uses significant debt financing to finance such a deal and risks their credit ratings. But not only do we see one company do it, we saw two companies do it. So just a quick highlight of my thoughts there. So looking at 2017, I think the question is going to be how cheap do these bonds come from AT&T and CenturyLink? What happens to the ratings? What other companies are willing to trash their balance sheets to make an acquisition? I think those are going to be big issues for 2017. Looking at AT&T Time Warner, so AT&T had a 2.3 times leverage target and a high BBB credit ratings from Moody's and S&P. They had a very well publicized, often stated goal to reduce their leverage down to about 1.8 times and return to single A credit ratings from Moody's and S&P, which they lost about a year and a half ago when they levered up for DirecTV and spent $18 million in Spectrum. So that was the goal until they saw Time Warner, and then now they're going to issue $35 to $40 billion of debt to finance the deal, so get ready. They're going to move their leverage up to about 2.7 times on 2018 numbers. And all three rating agencies have put them on review for downgrade. So we could easily see AT&T with a pro forma debt load in the $170 to $180 billion range, blowing away past Arnold's Banks as the biggest representative in the Bloomberg Barclays IG index. And they could be sitting at a mid-BBB credit rating. So today I actually put out an AT&T Time Warner merger model. If you see it on the terminal, you could click it, download it in Excel, and use it. The inputs include cost of debt, cash tax rate, how much you think AT&T is going to spend in the current 600 megahertz broadcast spectrum auction, and those are all drivers. So looking at consensus, you end up with about a 2.6 times leverage ratio for 2018, and you do end up with a free cash flow to debt ratio of about 6.5%, which actually are not bad numbers. Now they have to make those numbers and they have to hit it, but that's kind of where you wind up. And like I said, all three agencies have them on review. We could see AT&T with a mid-BBB from both S&P and Moody's. Okay, so that was Sunday before last, and this month, walking Monday morning, obviously we CenturyLink. CenturyLink says, wow, I went up for AT&T, maybe I'll trash my balance sheet also. So CenturyLink agreed to pay a very large premium for level 3. They decided that even though they're levered 2.9 times and have a 3 times target, let's move it up to 3.7 times. And let's issue, let's finance it with $8 billion of debt, which is going to have security and guarantees, and come ahead of about $9 billion of holdco bonds outstanding. So now those holdco bonds are under review for downgrade, and both given the reaction from both the equity and the debt, CenturyLink didn't seem to make either side of the balance sheet happy, given the price reaction. So that's something to look forward to also. So that's what's going on in M&A. So get ready. We got a lot of bonds coming. They will come cheap. The good thing, AT&T bonds rated BBB now, trade wide of BBs. So you look at them compared to BBs in the index, they trade pretty wide. New debt may even come wide to that, so it could be a good opportunity. And CenturyLink's a BB that wishes to trade in line with a single B. So those bonds should come at pretty attractive levels also. So I'll quickly highlight wireless. Wireless could also be interesting in 2017. We have the ongoing FCC 600 megahertz spectrum auction. A lot of participants. They have about $54 billion of firepower, and you look at AT&T, Dish, T-Mobile, and Verizon, but they have other spending considerations. I talked about AT&T already. Will the cable companies enter wireless? So they're talking about using Wi-Fi hotspots in an MVNO agreement they have with Verizon, but the question is, will they buy their way in? Comcast and Charter will have a lot of financial firepower in 2017, so they could do something there. Targets that are often mentioned in the news are names like T-Mobile and sometimes Sprint. Dish, sorry, just one more. I'll come back to Dish is one of the most interesting ones. They're pretty highly levered. They have a lot of cash that they've spent on spectrum. They're participating in the current spectrum auction. But the one risk of the bonds is that the bonds are issued from Dish DBS Co., which is their satellite company, and they're levered about 4.5, 5 times there. They've sent all the cash up to the parent company, who's utilized that cash to buy spectrum. No guarantees from the parent company. If they were ever to separate the two entities, you could have sent up, over $10 billion in cash to purchase these licenses and not get any benefit from it. So I'll just quickly go through the slides to save some time for what I see. So here's the potential impact. We look at the potential spenders in the auction. AT&T still may spend about $9 billion in this auction, even though I talked about what's happening with their leverage profile with Time Warner. Verizon has capacity to spend a little bit, but they are also trying to regain single A credit ratings from Moody's and S&P, and they have a target to get to 1.8 times net leverage by 2018, 2019, so they may not spend more than that. T-Mobile may be a big buyer. They've committed to spend $10 billion, or a max of $10 billion. They spent a couple of billion on 700 megahertz auction, so they could spend about 8. Comcast and Charter have a lot of financial firepower to enter wireless if they want to. Charter is producing a hell of a lot of free cash flow. EBITDA is growing rapidly, and they are quickly deleveraging. They could be down to about 3.4 times levered in 17, which is below the low end of the leverage target of 4 to 4.5 times. Comcast produces a lot of free cash flow, has good EBITDA growth, single A balance sheet. They clearly have the capacity to move into wireless if they wanted to. And I talked about Dish. The big risk here again is Dish DBS has sent about $15 billion up to the parent company. They have no recourse. That is a risk, and we have to figure out what Dish is going to do with all this spectrum. Are they going to pay to build out a network, or are they going to sell it, lease it? How are they going to monetize it? So that's a big issue for the Dish bonds. And with that, I'll pass it over to YC.
All right, thank you, Steve. So I'm YC Co. I just joined Bloomberg Intelligence about 3 months ago from Barclays, and I'm covering I'll be covering technology both on the IG and high yield side at BI. So I just published a thematic deck probably a couple of days ago on what's going on with technology in the bond markets. So for those of you who have been participating in this market, you've noticed that there's been a lot of bonds this year from the IG technology issuers. This chart shows you right now, as of end of October, we've got about 115 billion of issuance just in the US dollar IG type markets, and this surpasses the record-setting, 107 billion last year. And this month, or rather in October, there was no issuance. So think about that. Pace has been right now. If you include October, it's up like 10% year on year. Next chart. So if you look at the Bloomberg Barclays Credit Index, what I've highlighted here are the top Microsoft, Apple, and Oracle. They are top 15 in terms of the index presence. So notice that Microsoft and Apple are 1.16% of the index, Oracle is 1% of the index. At the end of last year, they were barely 0.85% of the index. So think about how much it's grown in terms of size. Next chart. And then this is the actual IG Tech Index. It's 7.7% of the IG Corporate Index. At the end of last year, was only 6.6%. So it's actually grown by 30% over the course of 2016. So that's how fast it's been growing. Next slide. So what's been driving this issuance trend? So we'll go through the drivers here. So first of all, M&A. So deal activity has been elevated. So 2016 Q3, when we screened for deals which were 500 million or more, in terms of the number of deals that were announced or proposed, this is actually at a record 54, and that dollar volume is 149 billion. So in Q4 already we've reached around close to 100 billion in terms of the dollar, in terms of deals that have been announced or potentially maybe proposed. So what's also happening is technology companies have been starting to pay out more of their free cash flow in terms of dividend. So if you look at this chart, which we've been tracking technology companies with over 30 billion in terms of market cap or more than 5 billion of debt, you notice that what was like almost zero back in 01, this is the median LTM free cash flow to LTM dividend to free cash flow. What was almost zero back in 01, right now it's close to 22% of free cash flow. And this is just 3% below the S&P 500 median. What tech companies have also been doing is buying back a lot of shares. So if you look at the latest number here, as of 2Q, they have been allocating about close to 60% of free cash flow for share buybacks. And this is ahead of the S&P 500 median, which is closer to like 51%. Now, what's also interesting, one of the trends that we've been seeing is a lot of tech companies, just given their international presence, they have a lot of cash that's trapped offshore. So what we've looked at in terms of the tech companies that I've talked about earlier, in terms of over 30 billion in market cap or more than 5 billion of debt, is for tech, the median ratio of domestic cash as a percentage of its overall cash and marketable securities, that tech index universe is 14%. For the S&P 500 median, that's closer to like 35%. So think of all that offshore cash that's being trapped, that's sitting outside of the U.S. So one way we've thought about looking at it is just given that companies are starting to issue debt in lieu of this offshore cash. So if you try to repatriate a cash back to the U.S. And if you assume that they're going to be hit with a 35% statutory tax rate for that. So if you work out how much debt could you issue so that kind of offsets the offshore cash that you have, that gets you to about 150%. So if you have like 1.5 billion of cash sitting offshore, technically if you repatriate it, you could issue $1 billion of debt to try to offset that. So if you assume that it's a net offshore cash neutral position, that ratio is 1.5 times. So look at the median for the S&P 500. It's about 20%. So it's so for every $20 of offshore cash, you have about $100 of debt, US total debt that you have on the balance sheet. For the tech companies, that median ratio is closer to 2 times. So and this ratio is starting to come down because what a lot of these tech companies are doing is they're issuing a lot of US dollar debt in lieu of this offshore cash. So but it's still sitting on, that ratio is still like 2 times, which is quite a high number. And what we did was we took a look at which are the companies which are still sitting on a lot of offshore cash versus the amount of debt that they have. The one that stands out the most is Google, Alphabet Inc. So this is at almost 11.4 times of offshore cash versus total debt that they have on the balance sheet. So some of the other names which you see very regularly, Apple, that ratio is like 2.5 times. So this is in terms of percentage, so 253%. Cisco is at 2.1 times. Microsoft is 2 times, although the latest quarterly filings is closer to 1.5 times because they did raise a fair amount of debt to finance the LinkedIn acquisition, which hasn't quite closed yet. So, and then you also have Qualcomm, which just recently announced that they're going to acquire NXP. That ratio is 2.4 times. So you're seeing a lot of what you're seeing is the combination of these factors. I think cash flow generation is becoming more predictable for the tech industry as it matures, and so you're seeing the tech companies using more of the cash flow for dividend payments, share buybacks, and acquisitions. And because a lot of these of their cash is also trapped offshore, what as a part of their financing strategy, what a lot of these tech companies are doing is raising US dollar debt in lieu of that cash. So looking at 2017, I think the M&A trend has not abated. I think if anything, it's kind of picked up. So I was joking with Steve earlier that like every day this week I've seen either an announced M&A deal in semiconductor land or a potential merger announcement. I think this deal activity is going to remain elevated. And then as you start to see companies start to mature and think about how they're going to allocate capital for those with a lot of cash that's being trapped offshore, you might start to see this trend picking up and continuing into the new year. So, in terms of issuance, I think this is, although 2016 so far has been a banner year, I think this trend is probably going to continue into the new year. Then that's all I have for now.
Thank you so much, YC, and thank all of you for sharing your evening with us tonight. All of our guests, we appreciate it so much. I just want to go through a couple of events that are coming up that obviously you're all welcome to join us. On the 17th, Marty Fritzen and BI, this will be our third time doing it together, looking at the high yield market, where is it, what his views are on valuation. Of course, our experts coming in and drilling down to the company level and the bond level to talk to specific issues. On the 29th, Rich Burke in the back is leading a presentation with covenant review. About a half a dozen companies are going to be discussed there and their covenant packages and what it might mean for the bonds. Then on December 8th, Matt Geithner and I will be working with the folks from S&P, talking about their outlook for autos and industrials and rails. And of course, we'll come in and talk relative value on the sectors. All of those you can sign up for at SMNR on the terminal, or you can use the link, or feel free to contact Matt or I. And then other things to come, PI puts out a very thick book for their outlook in December, the 2017 outlook, and Brent will be a part of that. And then more importantly, using the BI analysts, as you can see, one of the reasons why I'm so excited about the prospects for BI credit is the talent that I get to deal with every day. It's really a top-notch group of guys. Very, very exciting to see the growth of the group. That's going to continue into next year as we build out our European base. And thank you again, and feel free to ask us questions afterwards, and enjoy your evening. Thank you so much.
There's cocktails and hors d'oeuvres in the room if anybody wants to stay.